All right, let's drill down on what the market is doing right now and what investors want to hear at the top of the hour from Fed Chair Powell, and then at the bottom of the 2 p.m. hour when he addresses the press and takes questions. With us now, Jamie Cox, managing partner at Harris Financial Group, and Ivory Johnson, founder of Delancey Wealth Management. Welcome back, guys.
Thanks.
We know how to plan the good weather, don't we? Last time we were together in December was like this, and here we are, lucky enough again. What do you expect to hear from the Fed? I think everybody has baked in this idea of a quarter-point rate hike. How many do you expect this year? What do you expect to hear from the Fed?
I think we all know today is 25 basis points, but the big question is how many more? So I think that the Fed is probably, with its six rate hikes into this year, I don't think they're going to be able to do it. I think it's going to be very difficult for them to raise rates into an economy that's slowing. You have inflation that's taking a bite out of consumers' pocketbooks. You have higher energy prices. It's going to be very difficult for the Fed to continually raise interest rates throughout this year. But they could flip over and start with balance sheet reduction, which actually might be more effective than raising rates.
Might that be less painful?
I think so.
To the economy?
I think so. I think, the money supply increased so much over the past couple of years that reducing the balance sheet actually is probably going to be more effective. You're going to have, the interest rate environment adding interest rates, rising rates to rents or mortgages or anything like that on consumer balance sheets at this point is not a good idea.
So you're in the camp who says the economy is more vulnerable than lots of people give it credit for, yes. Than most people think, and therefore, under all the pressures the Fed faces, they may not go with a rate hike every time. Rejoinder to that, Ivory?
Yeah, I think 25 basis points is what we'll see. They're pricing in 6 or 7 rate hikes if you look at the 2 years, but it's already happened, right? So the 2-year yield's already gone up a little bit. I don't see how they raise it more than 2 times. To your point about, the economic slowdown, I don't think investors have fully priced in the deceleration in GDP growth. Just to give you an example, $1.3 trillion in federal spending is going away. That's 6% of our GDP. And so to paraphrase a local poet, Powell's trying to thread a needle as narrow as gun barrels because he's trying to cut back on the inflation, even though we do have disinflation while the economy is decelerating.
So let's talk a little bit. One final question for both of you. Where do you think inflation is heading? And is there any chance that this year we see it back at the Fed's long-term target of 2%? Ivory?
I think those odds are very low. I don't think it'll be anywhere near the 8% year-over-year rates. If you look at, we're not going to have a duplication of the rents going up the way they were or energy prices going up the way they were, but certainly not at the same rate that we saw in the last year.
Where's inflation heading?
Let's not forget this is an election year. You're likely to see Congress change. If Congress changes, government spending, which is already declining and decelerating, going to grind to a halt. So you're going to have a disinflationary pressure going into next year. So I just think it's going to be very difficult for the Fed to raise rates into that environment too much.
Jamie Cox, Ivory Johnson, thanks. We'll be back with you later.